Hello everyone, our topic for today is all about depreciation. It is important to analyze how companies use depreciation, which can represent a significant portion of the expenses on a firm's income statement and which can impact the value of an investment opportunity in the short term. While there are rules governing how to expense depreciation, there is still plenty of wiggle room for management to make creative accounting decisions that can mislead investors. It pays to examine depreciation closely. Then companies tend to work hard to make sure their fundamentals look good to investors and analysts. So it's essential to exercise good judgment when examining numbers that appear on financial statements. It's not enough to know simply whether a company has, say, great looking earnings per share or a low book value. Investors need to be aware of the assumptions and accounting methods that produce those figures. So, what is depreciation? Depreciation is an accounting process by which a company allocates an asset's cost throughout each useful life. In other words, it records how the value of an asset declines over time. Each time a company prepares its financial statements, it records a depreciation expense to allocate a portion of the cost of the buildings, machines, or equipment it has purchased to the current fiscal year. The purpose of recording depreciation as an expense is to spread the initial price of the asset over its useful life. For intangible assets such as brands and intellectual property, this process of allocating cost over time is called amortization. For natural resources such as minerals, timber, and oil reserves, it is called as depletion. So let's go to the assumptions. There are critical assumptions about expensing depreciations, and it's up to the company's management. Management makes the call on the following things. The first one is method and rate of depreciation. Second is the useful life of the asset. Third is the scrap value of the asset. And how we're going to calculate the depreciation. So calculation choices depending on their preferences, or companies are free to choose from several methods to calculate the depreciation expense. To keep things simple, we'll summarize just the two most common methods. The first one is straight line method and the second is accelerated method. Now let's go to the first method, which is the straight line method. This takes an estimated scrap value of the asset at the end of its life and subtract it from its original cost. This result is then divided by the management estimate of the number of useful years of the asset. The company expenses the same amount of the depreciation each year. So, as you can see in the illustration, that's the formula of straight line method, which is straight line depreciation is equals to original cost of an asset minus scrap value divided by estimated asset life. Now let's go to the second method, which is accelerated method. So this method write off depreciation cost more quickly than the straight line method. Generally, the purpose behind this is to minimize taxable income. A popular method is the double declining balance, which essentially doubles the rate of depreciation of the straight line method. So this is the formula of double declining depreciation, which is equals to 2 times original cost of an asset minus scrap value divided by estimated asset life. Now, what is the impact of calculation choices? So, as an investor, you need to know how to make a choice of depreciation method that affects an income statement and balance sheet in the short term. So, here's an example. Let's say the tricky company purchased a new IT system for $2 million. Tricky estimates that the system has a scrap value of $500,000 and that it will last for 15 years. So this is the solution. The 2 million minus 500,000 divided by the useful life of the asset, which is 15 years. So that would be 100,000. This is the depreciation expense. So according to the accelerated depreciation or accelerated double declining depreciation, Tricke's depreciation expense in the first year after buying the IT system would be this below. 2 times straight line rate is equals to 2 times 2 million minus 500,000 divided by 15, and 2 times of in the straight line rate, and it is equals to 200,000. This is the double declining depreciation. So as you can see, the amount from 100,000, it became 200,000. So it doubles the amount. So the numbers, as you notice, show that if Tricky uses the straight line method, depreciation cost on the income statement will be significantly lower in the first year of the asset life, which is 100,000, rather than the 200,000 rendered by the accelerated depreciation schedule. That means there is an impact on earnings. So if Tricky is looking to cut cost and boost earnings per share, it will choose the straight line method, which will increase its bottom line. So a lot of investors believe that book value or net asset value offers a relatively precise and unbiased valuation metric. But again, you have to be careful. Management's choice of depreciation method can also significantly impact book value. Determining Tricky's net worth means deducting all external liabilities on the balance sheet from the total assets after accounting for depreciation. As a result, since the value of net assets doesn't shrink as quickly, straight line depreciation gives Tricky a bigger book value than the value a faster rate would give. So these are the impact of the assumptions. First is Tricky choose a surprisingly long asset life for its IT system, 15 years, which is 15 years. Information technology typically Information technology typically becomes obsolete quite quickly, so most companies depreciate technology over a shorter period, say 5 to 8 years. Third is then there is the issue of the scrap value that Tricky choose. It's hard to trust that a used 5-year-old system would fetch a quarter of its original value. And then fourth is perhaps we can see the reason for a Tricky's decision. The longer the useful life of an asset and the greater the scrap value, the less its depreciation will be over its life. And last one is a lower depreciation raises reported earnings and boost book value. Tricky's assumptions, while questionable, will improve the appearance of its fundamentals. So as a closer look at depreciation should remind investors that improvements in earnings per share and book value can, in some cases, result from little more than strokes of the pen. Earnings and net asset values that are boosted thanks to the choice of depreciation assumptions have nothing to do with improved business performance and, in turn, don't signal strong long term fundamentals. So, per the matching principle of accounting, depreciation ties the cost of using a tangible asset with the benefit gained over its useful life. There are many types of depreciation, including straight line and various forms of accelerated depreciation. Accumulated depreciation also refers to the sum of all the depreciation recorded on an asset to a specific date. The carrying value of an asset on the balance sheet is its historical cost minus all accumulated depreciation. The carrying value of an asset after all depreciation has been taken is referred to as its salvage value. So this ends the our lesson about depreciation. Have a good day, everyone.